Have you ever wondered why prices in the market sometimes skyrocket, then sharply slow down, and sometimes even change direction? At first glance, it may seem like complete chaos, but in reality, behind price movements lie certain patterns. And there are tools that help see these patterns. One such tool is the Stochastic Oscillator. In this video, we will break it down in the most accessible language, without complex formulas or fancy terms. My goal is for you to finally understand the purpose of this indicator and be able to apply it in practice. This will especially be useful for those who are just taking their first steps in online trading and are looking for simple yet effective tools. To better understand the essence, let's go back a few decades. In the 1950s, American analyst George Lane introduced the world to an indicator that changed the approach to market analysis. Lane proposed looking not only at the asset's price, but also at the speed and the force with which it moves. He gave very visual comparison. The market is like a runner. A runner can accelerate, but cannot speed up endlessly. There comes a point when the pace starts to fall. Breathing becomes irregular, and this is a signal that a stop or reversal will soon occur. It is precisely at such moments that the stochastic helps. Thanks to this simple but brilliant idea, the indicator quickly gained popularity and remains one of the most sought after tools among traders worldwide. Now, let's figure out how it works. The Stochastic shows the state of overbought or oversold markets. When the price rises too quickly and reaches a peak, it's called overbought. And if the market falls sharply and hits a bottom, it's oversold. The indicator is built as two lines. One line is faster, the other is smooth. Their crossings and positions relative to levels helps the trader understand the current situation. If the lines cross in the upper zone of the chart, about 80 level, it's a signal of overbought conditions. If they cross in the lower zone, below the 20 level, it indicates oversold conditions. For a trader, this is a hint the market may slow down or reverse. For example, if in the overbought zone, the lines cross downwards, many see this as a sell signal. And if in the oversold zone, they cross upwards, it's a hint to buy. Traders watch for such moments to timely find an entry point for a trade. Why is this stochastic so loved, and not only by beginners, but also by experienced market participants? First, it's simple and visual. It's easy to understand, even if you're seeing it for the first time. Second, it's suitable for any time frame, be it a minute or daily charts. Third, it helps discipline trading. If there's a signal, it's worth stopping, analyzing, and making a decision. However, it should not be forgotten that the stochastic does not give 100% hints. It shows probabilities, not ready-made answers. You should be especially cautious during strong trends. At such times, the indicator may signal against the movement, but the market will continue in the same direction. That's why professionals never use the stochastic alone. It's always combined with other tools. For example, you can take a moving average like the EMA to determine the overall trend, and then use the stochastic within that trend to find a specific entry point. This creates a simple and understandable strategy. First, you determine the direction. If the trend is upward, you only consider buying opportunities. If it's downward, you consider selling opportunities. Then the stochastic comes into play. It helps find the moment when the price has temporarily pulled back, but remains within the trend and is ready to move further. This approach is much more reliable than trying to guess a reversal. At this point, Many naturally have a question: how to apply all of this in practice, where to find more examples, and information about indicators. To make it easy for you, I have collected additional materials and examples in my Telegram channel. Plus, every week I hold a giveaway where lucky winners get 100% boost to their deposit. Leave a comment, I want to enter the giveaway, and I'll send you a special link. This is a great opportunity to try yourself in real trading without risking your own capital. But let's get back to our topic. Another strong point of the stochastic is its work in conjunction with support and resistance levels. If the indicator signal coincides with a level on the chart, the probability that the price will actually react is much higher. Furthermore, the stochastic can be used to look at divergences. These are situations where the price indicates a new high, but the indicator does not confirm it. Such a signal often warns that the movement is losing strength. You can master all of this gradually. Start simple, apply the indicator to a chart, observe it, and note for yourself which signals coincide with the price. Over time, add filters, levels, moving averages, trend analysis. This approach will help you develop an understanding of the market step by step, without unnecessary haste. Today, we've broken down the basics of working with the stochastic, its history, and a strategy suitable even for beginners. Now, you know what overbought and oversold zones mean, how line crossing work, and what mistakes to avoid. Today, we covered in detail the history of the stochastic indicator, how it works, and a simple strategy that any beginner can master. Now you have an understanding of how overbought and oversold works, and why you shouldn't rely on just one tool. Thank you for staying with me until the end. Subscribe to the channel, hit the like button, and be sure to share your thoughts in the comments. This is very important to me because your questions and feedback help me make videos more useful and interesting. And see you in the next episode.